Ladies and gentlemen, gather around and prepare to embark on an unforgettable journey into the exhilarating world of stocks and financial wizardry. Welcome to Stock Marketpedia, where the stock market meets showtime. Let's kickstart this electrifying adventure together and redefine what it means to be the stock market superstar. So without further ado, hit that play button, fasten your seatbelts, and let the financial extravaganza begin. Get ready for a wild ride because Stock Marketpedia is here to rock your world. In this video, we'll analyze the process of investing in the stock market for newcomers in a detailed manner. It's essential to keep in mind that the ultimate objective of investing is to eventually rely on our investment portfolio as a source of income. However, we must acknowledge that we need to begin at the beginning. It's not possible to instantaneously achieve a carefree life of leisure, enjoying dividends while lounging at a beach. So let's commence with the fundamentals and systematically explain how to enter the world of investing. Why invest in stocks? I invest in stocks because I'm drawn to the concept of passive income rather than active income. There are two main ways to earn money: actively working for it, which is known as active income, and owning assets that generate income for you, known as passive income. Stocks fall into the latter category. When you own stocks, you become a small owner of a company, and it can generate income for you without requiring additional work. This passive income aspect is the primary reason I chose to invest in stocks. It allows me to earn money without having to constantly work for every dollar. By leveraging the power of ownership in businesses, stocks offer the potential for financial growth and freedom. What are stocks? A stock is a financial instrument that symbolizes partial ownership in a business. For instance, when you own a stock of Coca-Cola, you become a minuscule owner of the company itself. This ownership arrangement aligns with Robert Kiyosaki's cash flow quadrant, specifically the fourth square, where you become a business owner without the need to actively work for it. In essence, by investing in stocks, you enter the realm of owning a fraction of a business, enabling you to participate in its potential growth and success. This allows you to reap the benefits of being an owner while avoiding the responsibilities of day-to-day business operations. How do we get started? To purchase stocks, you'll need to register with a brokerage company, which is an online platform facilitating stock buying and selling. But don't worry, this isn't the era of shady Wall Street brokers. Instead, opt for a reputable brokerage firm with a solid track record. If you're a beginner and seeking a cost-effective option, platforms like Robinhood and Webull are quite popular. These platforms allow you to buy and sell stocks without any fees. On the other hand, these companies have been around for a significant period and are relatively easy to sign up with. If you reside in the USA, simply search for these brokerage companies on Google, visit their websites, and complete a few straightforward forms. This will fulfill step 1 of the process, finding a stockbroker. It's as simple as that. Remember, it's crucial to choose a reliable and reputable brokerage company to ensure a smooth and secure investing experience. 4 types of investing. This is the critical part where many people make mistakes by letting greed cloud their judgment. Instead of making money, they end up losing it due to unwise and uninformed investments. Firstly, you need to choose an investing strategy and then select suitable stocks. Let me outline 4 different approaches. You can choose the style that best suits your specific situation and investment goals. Number 1, passive index fund investing. This laid-back approach involves investing in index funds, which are diversified portfolios mirroring a particular market index. It's a low-maintenance strategy that tends to perform well over the long term. Number 2, growth investing. This style, exemplified by investor Cathie Wood, involves targeting stocks of companies expected to experience rapid growth in the future. It focuses on capturing the potential for significant capital appreciation. Number 3, value investing. This approach, followed by successful investor Warren Buffett, involves identifying undervalued stocks with long-term growth potential. It aims to find stocks that are priced lower than their intrinsic value. Number 4, dividend investing. This approach focuses on generating passive and reliable income through regular dividend payments. It's a great option if you seek steady income streams. Consider these different approaches and select the one that aligns with your investment preferences and goals. It's crucial to remember that each approach has its own benefits and drawbacks, so make an informed decision to avoid unnecessary risks and maximize your chances of success. Style 1, passive investing. Passive investing in an index fund is a great option if you don't have the time or interest to research and analyze individual stocks. Surprisingly, index investing actually outperforms many big hedge funds, and this fact has been endorsed by renowned investor Warren Buffett. An index fund is essentially a collection of stocks that mirrors a specific market group. For example, the S&P 500 index fund includes 500 large American stocks, tracking the overall U.S. stock market. The Vanguard Information Technology Fund focuses on more than 300 U.S. technology stocks, specifically following the tech sector. Another example is the Vanguard Dividend Appreciation Fund, which tracks a group of 247 companies known for consistently increasing their dividend payments over time. By investing in index funds, you can easily gain exposure to various market segments based on your investment preferences. It may sound too good to be true, but sometimes simplicity is the key to successful investing. As Warren Buffett suggests, opting for a low-cost index fund and gradually investing over time can yield better results than most people who start investing around the same time. To purchase an index fund, you simply need to enter the fund's ticker symbol on your brokerage account. Whether you choose a global market index fund, a real estate fund, a healthcare fund, or any other sector-specific fund, you can tailor your investments based on the sectors of the market you want to be a part of. The beauty of index investing lies in its diversification, as you're spreading your investment across a range of companies within a specific market group. This helps reduce the risk associated with investing in individual stocks, as any underperforming stocks are balanced out by the others. Additionally, index funds typically have lower fees compared to actively managed funds, allowing you to keep more of your investment returns. While index investing may not promise astronomical returns like picking individual stocks, it offers a reliable and proven approach to long-term wealth accumulation. It's a strategy that emphasizes the power of time, consistent contributions, and broad market exposure. By harnessing the benefits of index funds, you can build a well-rounded investment portfolio without the stress and effort of constantly monitoring individual stocks. Dip your feet in. Don't wait too long to start investing. Do your initial research, understand the basics, but you don't need to be an expert like Warren Buffett before you begin. Start by buying your first stock with a small amount of money. Stocks like Ford, priced at $20, or Apple, priced at $180, and Coca-Cola, priced at $60, are not overly expensive. Get in the game and learn as you go. The worst thing you can do is wait, lose motivation, and end up not investing at all. How to deal with high stock prices. One question we may have is whether it's wise to invest when stock market prices are already high and we've been experiencing a long period of rising prices. We need to adopt a long-term perspective when it comes to investing, as Warren Buffett suggests. Instead of worrying about short-term market fluctuations, we should consider the next 5 to 10 years. Over time, the market tends to go up because businesses generate earnings and continue to grow. Even if there's a market crash after we invest, it's important not to panic and sell. In fact, following Buffett's approach, we should see a crash as an opportunity to buy more stocks at lower prices. During a crash, stocks become cheaper, and there's potential for even greater profits. By investing in high-quality stocks that generate income, add value to customers, and drive innovation, we can still make money even during market dips. The key is to invest wisely and have confidence in the companies we choose. Rather than being afraid of a market crash, we can see it as a chance to buy stocks at a discount. By thinking long-term and focusing on the fundamentals of the businesses we invest in, we can navigate market volatility and potentially achieve solid returns. So there's no need to fear a crash if we approach investing with a smart strategy. That's a wrap for today's video, but the excitement doesn't stop here. Get ready for more mind-blowing content coming your way. We'll be pumping out videos 3 to 5 times per week, so buckle up for an exhilarating ride. Drop your comments below with your topic requests because we want to hear from you. And don't forget to smash that like button, subscribe, and hit that notification bell to stay in the loop. Stay tuned for the next thrilling episode on Stock Marketpedia, where we make stocks sizzle.